Millions of seniors heard that the Big Beautiful Bill eliminated taxes on Social Security. The SSA itself said nearly 90% of beneficiaries would no longer pay. But PolitiFact rated Trump's broader no tax on Social Security promise mostly false. 24 million Americans still owe federal income tax on their Social Security benefits. The formula didn't change. The original thresholds from 1984 didn't move. Congress added a second tier in 1993 and froze that one too. And the deduction they gave you? It doesn't even touch the number that determines whether your check gets taxed. But that's not the worst part. The real damage is a hidden mechanism buried inside the tax code that nearly doubles your effective tax rate on every dollar you pull from your IRA. A $1,000 withdrawal that should cost you $220 in taxes. It actually costs you $407. By the end of this video, you'll know the exact formula the IRS uses, why a 1984 law designed for the top 10% of retirees now traps 56%, and 4 legal moves that can slash or eliminate this tax, including one that lets you give $108,000 to charity completely tax invisible. If that sounds like something you can't afford to miss, subscribe now, because every strategy in this video has a deadline, and I'm going to walk you through each one. Who does this actually hit? When Social Security taxation started in 1984, fewer than 10% of retirees were affected. Today, roughly 56% of beneficiary families owe federal income tax on part of their Social Security. That's the SSA's own projection. If your household income is somewhere between $40,000 and $90,000 a year, a retired teacher and an electrician with a pension, an IRA, and Social Security, you are very likely in the zone. And the thresholds that determine whether you're taxed? The original ones, $25,000 for singles, $32,000 for couples, have not moved $1 since 1984. Congress added a second set in 1993 at $34,000 and $44,000. Neither set has ever been indexed for inflation. Neither was adjusted by the Big Beautiful Bill. A couple making $44,001 in what they call provisional income hits the same 85% taxable rate as a couple making $500,000. There's no top cap that hits the wealthy harder. The system was built for them, but it doesn't distinguish them anymore. We're covering 4 things. First, the formula, what actually counts as income in this calculation. Then why these thresholds are absurdly low. After that, the torpedo and the hidden rate multiplier that nearly doubles your tax on IRA withdrawals. And finally, 4 strategies to fight back. The IRS uses something called provisional income to decide how much of your Social Security gets taxed. 3 inputs. That's it. First, your adjusted gross income, everything except Social Security. IRA distributions, pensions, wages, capital gains, rental income, dividends. All of it. Second, tax-exempt interest, and yes, that includes municipal bond interest. We'll come back to that. Third, 50% of your Social Security benefits. Not the full amount, half. Add those 3 together. That's your provisional income. Now the zones. For a single filer, below $25,000, 0% of your Social Security is taxable. Between $25,000 and $34,000, up to 50% becomes taxable. Above $34,000, up to 85%. For married filing jointly, below $32,000, 0. Between $32,000 and $44,000, up to 50%. Above $44,000, up to 85%. The maximum is always 85%, never 100. At least 15% of your Social Security is always tax-free. Put a real face on those numbers. A married couple, he's got a small pension of $22,000. She's pulling $15,000 a year from her IRA. And together they collect $36,000 in Social Security. Add the pension and the IRA, $37,000. Add half their Social Security, $18,000. Their provisional income is $55,000. They blew past the $44,000 joint threshold by $11,000. 85% of their Social Security is now taxable. They thought they were solidly middle class. By IRS standards, they're in the same bracket as a couple earning 10 times that amount. And nothing about this couple is unusual. That income mix describes millions of retired households across the country. Now, the Muni Bomb, municipal bonds. The investment your broker specifically marketed as tax-free. Congress wrote Muni Bond interest into this formula on purpose. In 1983, they did it deliberately to prevent high-income retirees from sheltering income in munis and ducking the Social Security tax. A retiree with $50,000 in Muni Bond income and $30,000 in Social Security has $65,000 in provisional income. deep in the 85% zone. Their tax-free bonds are making their Social Security taxable. Two critical exclusions before we move on. Roth IRA. Qualified distributions are not in this formula. They don't appear in AGI, so they don't touch your provisional income. And qualified charitable distributions from IRAs, also not in the formula. Remember those. They matter later. One more thing. If you're married filing separately and you lived with your spouse at any point during the year, your threshold is 0. 85% of your Social Security is taxable from the first dollar. $25,000. That single filer threshold. Who decided that number, and why hasn't it changed in 42 years? Not an accident. That's the next part of the story. Social Security was completely tax-free from 1935 to 1983. Nearly 50 years. Your parents probably collected their checks without ever thinking about the IRS. That changed because of the Greenspan Commission. In 1983, they recommended taxing Social Security benefits for the first time. Congress set the thresholds at $25,000 for singles and $32,000 for couples, calibrated to affect only the top 10% of retirees. Revenue went to the Social Security Trust Fund. Then in 1993, Congress added a second tier. If your provisional income exceeded $34,000 single or $44,000 joint, up to 85% of your benefits became taxable. That extra revenue didn't go to Social Security. It went to the Medicare Part A Trust Fund. And what they didn't do, in either 1983 or 1993, was index these thresholds for inflation. The Congressional Research Service confirmed this was intentional. Lawmakers wanted the tax to gradually align Social Security with pension taxation over time. The non-indexing wasn't an oversight. It was a design choice. Do the math. If the $25,000 threshold had been indexed since 1984, it would be roughly $78,000 today. Instead, it's still $25,000, about 1/3 of what it should be. And every year, the trap gets worse. Social Security benefits are adjusted for inflation through the COLA, but the thresholds are not. Every cost of living raise pushes more retirees past the frozen line. The government gives you a raise with one hand and collects more tax with the other. A couple at $44,001 in provisional income faces the same 85% exposure as a couple at $500,000. The system was designed for the wealthy. It doesn't target them anymore. The thresholds are frozen. The formula pulls in income you thought was tax-free. And now, the part almost nobody explains, there's a hidden multiplier inside this system that can nearly double your real tax rate. This is the tax torpedo. Let me set up the scenario. A married couple, $76,000 a year in Social Security, $70,000 from IRA distributions. They're in the 22% bracket. They think they know what they owe. They need an extra $1,000 from their IRA. Expected tax, 1,000 times 22% equals $220. Simple. Except that's not what happens. That $1,000 withdrawal increases their provisional income by 1,000. And in the 85% phase-in zone, every single dollar of new income makes 85 cents of Social Security benefits newly taxable. The IRS doesn't just tax them on the 1,000 they withdrew. It taxes them on the 1,000 plus $850 of Social Security that just became taxable. That's $1,850 of new taxable income. At 22%, $407. The effective marginal rate on that IRA withdrawal? 40.7%. $1,000 in, 407 out. That's the torpedo. Let that number land. 40.7% on a retiree in the 22% bracket who had every reason to believe they'd pay 22%. This isn't a one-time surprise. It fires every single year they're in the torpedo zone. If that same couple needs to pull $30,000 from their IRA annually for living expenses, the torpedo doesn't hit once and stop. It hits on every dollar that falls inside the phase-in range. Year after year, they're paying nearly double what they expected on a chunk of their own retirement savings. The difference between what they planned for and what the IRS actually takes compounds over a 20-year retirement. And nobody warned them when they rolled their 401k into that traditional IRA. Take someone in the 12% bracket. Same multiplier. Every dollar still triggers 85 cents of newly taxable Social Security. 12% times $1.85 equals 22.2%. A retiree who believes they're in the 12% bracket is actually paying 22.2% on every IRA dollar in the torpedo zone. And the torpedo hits the middle class hardest. Very high earners have already cleared the 85% cap. Their additional income doesn't trigger more Social Security taxability because they're already at the maximum. The torpedo fires precisely in the middle income band where provisional income is crossing that $34,000 or $44,000 line. Another example, a couple at $61,500 in provisional income. Their car breaks down, $10,000 repair. They pull it from their IRA. Their taxable income doesn't rise by $10,000. It rises by $18,500. The $10,000 plus $8,500 in newly taxable Social Security. Effective rate, 22.2%. They never left the 12% bracket. But the torpedo doesn't care what bracket you're in. Most retirees have never heard of this. The torpedo is the mechanism they're missing, and it fires on the income range where most of them actually live. If you're thinking, at least my municipal bonds are safe from this, go back to what I showed you about the formula. Your muni bond interest is in the provisional income calculation. It's feeding the torpedo. There's one more trap I need to show you before we get to the strategies. Because the torpedo doesn't just hit your income tax, it can also hit your Medicare premiums 2 years later. And most people don't find out until the bill arrives. If your modified adjusted gross income exceeds $106,000 as a single filer or $212,000 as a couple, Medicare Part B and Part D premiums spike. This is called IRMAA, and it's a hard cliff. Exceed the threshold by $1 and you pay the full surcharge for the entire tier. Crossing that first line adds $888 a year per person in Part B alone. Worse, IRMA is based on your tax return from 2 years ago. A Roth conversion, or a large IRA withdrawal in 2025 hits your 2027 Medicare premiums. You won't see it coming until the bill lands in your mailbox. Say you retire at 63 and do a big Roth conversion that year to take advantage of a low-income window. Smart move for tax purposes. But 2 years later, when you turn 65 and enroll in Medicare, that conversion income shows up on the return the SSA pulls. Your very first Medicare premium is the surcharged one, and you never saw the connection between a retirement planning decision at 63 and a Medicare bill at 65. Picture the full squeeze. Your federal income tax bracket, the Social Security tax torpedo, and now the IRMAA surcharge. 3 systems all looking at the same income number. One unplanned IRA withdrawal can trigger all 3. A documented example, the last $10,000 of a Roth conversion produced $2,400 in federal tax savings at the 24% rate, but it triggered $3,473 in IRMA costs. A net loss of $1,073. The conversion saved money on taxes and cost more in Medicare. The escape hatch. Under current law, Roth YRA distributions are not counted in IRMAA. Once money is in a Roth, withdrawals in retirement don't affect your Medicare premiums or your Social Security taxability. You've got a frozen formula from 1984, a torpedo that nearly doubles your rate, and a Medicare surcharge that hits 2 years later. That's the bad news. Here's what you've been waiting for. 4 legal moves that can actually fix this. Strategy 1. The QCD, the $108,000 stealth weapon. If you're 70 and a half or older and you give to charity, your church, a food bank, your alma mater, route those donations through your IRA as a qualified charitable distribution. The 2025 limit is $108,000 per person. If you're a married couple and you're both 70 and a half or older, that's $216,000 combined. AQCD satisfies your required minimum distribution, but it never enters your adjusted gross income. It is invisible to the provisional income formula, invisible to IRMAA, invisible to the torpedo. This distinction matters. Taking an IRA distribution and then writing a check to charity does not give you the same benefit. That distribution hits your AGI first, increases your provisional income, and potentially taxes your Social Security. AQCD bypasses AGI entirely. The routing matters, same money, same charity, completely different tax result. Secure 2.0 left the QCD age at 70 and a half, while the RMD age rose to 73. That created a 2.5-year window where you can use QCDs to reduce your IRA balance before required minimum distributions even begin. And starting in 2026, Form 1099-R will use Code Y to flag QCDs, which makes reporting cleaner. For 2025, Code Y is optional. Your custodian may or may not use it yet. If you already give to charity and you have a traditional IRA, this is the single most efficient move available. Strategy 2. Roth conversions, pay tax now, escape the torpedo later. The optimal window is the gap years between retirement and when Social Security plus RMDs begin, typically ages 60 to 72. Your income is at its lowest. Your tax brackets have the most room. Conversions reduce future RMD pressure before it compounds. Converting before Social Security starts avoids the torpedo entirely. No Social Security benefits in payment means no benefits to be pushed into taxability. Every dollar you convert during those gap years faces only your marginal tax rate, not the torpedo multiplier. After Social Security starts, conversions still work. But the math changes. Every conversion dollar triggers 85 cents of additional taxable Social Security. Converting at 63 is cheaper than converting at 68 if Social Security is already running. One caution: large conversions at ages 63 or 64 can trigger IRMAA surcharges because of the 2-year look-back. Conversion income in 2025 affects your 2027 Medicare premiums. The cleanest window for avoiding IRMAA is ages 60 to 62, 2 or more years before you turn 65, and Medicare kicks in, so the look-back period clears before your first premium is set. Once you're on Medicare, Roth conversions still work, but you have to size them. Stay under the first IRMAA threshold, and the surcharge never kicks in. Go over and you'll pay higher premiums 2 years later. Once that money is in a Roth, it's done. Under current law, Roth distributions are excluded from both provisional income and IRMAA permanently. No torpedo, no Medicare surcharge. Strategy 3, income timing, the calendar year split. Think about this. A retired couple sits down in mid-December. Their provisional income for the year is $42,000, $2,000 below that $44,000 joint threshold. They need $10,000 from their IRA for property taxes due in January. If they pull it now in December, their provisional income jumps to $52,000. They've crossed the line. 85% of their Social Security is suddenly taxable for the entire year. But if they wait 2 weeks, take the same withdrawal on January 2nd, that $10,000 lands in a brand new tax year. Their December number stays at $42,000, zero additional Social Security taxed, same money, same bill getting paid, completely different tax outcome. 2 weeks on the calendar, that's all it took. The rule behind the story: if your provisional income leaves room below the $44,000 threshold in a given year, take deliberate IRA withdrawals or do conversions to fill up to that line without crossing it. You get the money out at zero additional Social Security tax cost, and you reduce future RMD pressure. For large one-time expenses, a car, a home repair, use your Roth IRA or a taxable brokerage account instead of your traditional IRA. Once Social Security is in the mix, the traditional IRA is the most expensive wallet to open. Every dollar from it feeds the formula. The order of operations matters as much as the amount. Which account you withdraw from determines whether the torpedo fires. Strategy 4. The $6,000 senior deduction, real but limited. The deduction is real. $6,000 per person age 65 and older. Up to $12,000 for a couple. Effective 2025 through 2028. The catch: it's a below-the-line deduction. It reduces your taxable income after AGI is calculated. It does not reduce provisional income. It will not change how much of your Social Security is taxable. The torpedo still fires. The formula doesn't see this deduction at all. It also phases out. Starts at 75,000 single, 150,000 joint. Fully eliminated at 175,000 single, 250,000 joint. A single filer at 100,000 loses 1,500 of the deduction. And it expires in 2028. No extension is guaranteed. 4 years. That's the window. Use this deduction. It helps your overall tax bill, but don't mistake it for a fix. It does not diffuse the torpedo. The system taxes your Social Security through a formula with frozen thresholds that now trap 56% of retirees. The torpedo nearly doubles your effective rate on IRA withdrawals. And the big beautiful bill didn't fix any of it. 4 legal moves, QCDs, Roth conversions, income timing, and the $6,000 deduction can cut what you owe. But 3 of them have closing windows. The deduction expires in 2028. Roth conversion windows narrow once RMDs begin at 73. QCDs require planning. Your custodian won't do for you. The time to plan is now, not next April. And if you live in one of the 8 states that still tax Social Security, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, you've got an additional layer on top of everything we just covered. West Virginia just eliminated its state Social Security tax in 2026, dropping the count from 9 to 8. The list keeps shrinking, but if you're on it, it matters. If this changed how you think about your retirement taxes, share it with someone who needs to hear it. And if you want to know how IRMAA can silently reduce your Social Security check year after year, that video is next.